Welcome to the Daily Vibecasting. Today we are diving into a feed that's really buzzing. We've got high-stakes corporate moves, some record-breaking market signals, and honestly some pretty provocative takes on wellness and even education. It's going to be a fast-paced trip, like always, through posts that really mattered in the last 24 hours. Our mission, extract the strategic so what from everything, give you those deep insights, quickly. Let's jump right into the market and money vibe. It seems like the news cycle is being driven by some super rapid reactions to policy and, well, just broader anxieties.
Oh, absolutely. What we're seeing is this fascinating mix. You've got companies scrambling to keep market share despite legislative shifts, and then there's this clear flight to safety from investors globally. It's quite the picture.
Okay, let's start with EVs. A really swift reaction in the electric vehicle market. Kicking things off with @SawyerMerritt. NWS, Tesla has increased lease pricing for the Model Y and Model 3 in the U.S. by up to 11%, but Tesla has also introduced a $6,500 lease credit to help offset the loss of the EV credit. Okay, wow. An 11% hike is sharp. That's a direct, almost instant reaction to the $7,500 federal EV tax credit expiring. They didn't waste any time.
Yeah, the initial reaction might be sticker shock, right? But the strategic play here is pretty brilliant, actually. Tesla's offsetting nearly the entire loss with their own $6,500 lease credit. But here's the crucial detail. It only applies to leases.
Okay. So they control the subsidy entirely themselves. If you lease, you get the immediate cash benefit straight from Tesla, not the government.
Precisely. So it keeps the affordability near parity, helps sustain that critical 20 to 30% market share they have. But it also means Tesla is betting on the long-term value of those cars, the depreciation risk. That's on them, not the person leasing it immediately.
Interesting. So they're choosing to absorb that potential cost internally just to keep the sales volume ticking over, even if it might shift how the cost plays out over the full lease term for the customer.
Exactly. It's a strong defensive move against what could be an industry-wide sales slowdown.
Right. Speaking of market anxiety, that flight to safety you mentioned, it's hitting headlines hard.
Right.
The Spectator Index reports a record jump for gold. Breaking. Gold hits record high of $3,900 an ounce. $3,900 an ounce.
Yeah.
Wow, that is a massive psychological barrier to cross. What factors drove such a dramatic surge?
Well, it was kind of a perfect storm of unease, really. The surge happened right amid these acute risks of a U.S. government shutdown, plus some really disappointing domestic jobs data came out. When those core indicators of stability, both political and economic, start to wobble, fiat currencies tend to suffer.
So this isn't just a blip then. Hitting $3,900, which, represents a 45% year-to-date increase? That signals something much bigger than just short-term jitters.
Oh, it does. It signals a broad and maybe accelerating erosion of global confidence in the fundamental integrity of fiat currencies. It pushes major investors towards historical safe havens like gold, which tend to hold value better amid inflation and, let's face it, persistent global tensions. It's like a loud alarm bell for the whole system.
Okay. And pivoting from traditional assets to digital ones. A Japanese investment firm is going all in, it seems, on Bitcoin. Let's check in with @WatcherGuru, JETINI. Bay's Metaplanet buys another 5,268 Bitcoin worth $600 million. They now hold 30,823 BTC worth $3.5 billion. Metaplanet is building a massive Bitcoin war chest. I mean, that's a hugely aggressive stance for a publicly listed company, isn't it?
It really is. And the motivation here is key. Metaplanet specifically adopted Bitcoin as its main treasury reserve because the Japanese yen has been depreciating significantly. They really ramped up these purchases through 2025 as a hedge.
So it's less about pure crypto speculation, maybe, and more using Bitcoin as a strategic defense against their own currency's weakness.
Exactly right. It immediately boosted them way up the rankings of public companies holding Bitcoin. And this aggressive buying, it pushed Bitcoin's price up 2.4% just on the day they announced it. It's a compelling model for other corporations out there, especially if they're operating in places facing serious local currency devaluation.
Okay, fascinating stuff. Let's transition now from money to the, constantly evolving and sometimes slightly confusing world of AI and enterprise tech, VIBES. This segment has some major funding wins and some truly polarizing product names.
The names are certainly memorable, trying to push boundaries, I guess, between serious enterprise stuff and, Silicon Valley accessibility.
Starting with Salesforce, and a name that's definitely making waves, here is @TechCrunch. Salesforce is also releasing a vibe coding agent named Codey to help companies foray into vibe coding with enterprise security. Vibe Codey. Okay, I can see why that's polarizing the tech sphere. It sounds, I don't know, like something out of a kid's show, not exactly a tool for managing complex corporate data and security.
Right. But Vibe Codey is, at its core, an AI agent designed to generate actual code from natural language prompts. And Salesforce is heavily stressing the crucial enterprise-level security integration. So the name, as polarizing as it is, maybe reflects that balancing act innovators are trying to pull off. They need the tool to be approachable, intuitive for maybe non-coders.
But it also has to be taken seriously by IT and security teams.
Exactly. That tension between Vibe and enterprise security, that's the whole debate right now.
Okay, from the giants, let's shift to high-speed startups. We've got a massive fundraise announcement from an incredibly young founder. This is from @ArlenRock, announcing at Nozomio AI's $6 2 million fundraise, led by @CRV, Box Group, and a local global VC back to work now. $6.2 million. Raised by Arlen Rahmatsan, who's, 18? And a high school dropout. That kind of rapid rise is the story Silicon Valley just eats up.
And it's based on tackling a really key technical problem, AI hallucinations when it generates code. His startup, Nozomio AI, built an agent called Nia, specifically designed to reduce those errors by giving the AI deeper context. That specific solution, tackling that pain point, is what attracted that top-tier VC money so fast.
So the focus isn't just generating code, it's generating reliable code. And he plans to use the money to hire other young builders, create a talent-dense startup, as he put it.
Yeah, it's proof that solving a very specific, very painful technical problem that still drives major investment regardless of the founder's age or, formal background. Impressive.
Now, onto the living room. Google's expanding its Gemini AI into the smart home. This is according to the official at Google Post. Welcome to the Gemini era of Google Home, powered by our most capable AI yet. Today, we're introducing the next generation of Gemini-powered Nest Cams and Doorbell, and the new Google Home speaker Gemini for Home, so you can talk and collaborate more naturally with your devices. Okay, Gemini moving into the home, promising natural collaboration, a unified experience. Sounds pretty comprehensive. But what's the catch? What's the access point here?
Well, the advanced AI features, things like genuinely proactive suggestions, integrated routines across multiple devices, they sound impressive. However, the catch, as you put it, is the price. You need that steep $40 a month Google Home Premium subscription to unlock the core Gemini features.
$40 a month on top of buying the hardware. Wow. That's a significant barrier, surely. Yeah. Does the value really stack up against that cost?
Well, critics are already pointing out that $480 a year just for advanced smart home features, that's way beyond what most people are typically willing to pay for subscriptions like this. It seems like it's probably targeting only the really high-end, most deeply integrated smart home users.
Right.
Though to be fair to Google, they did finally redesign the Google Home app. Users have been asking for better device management for ages, so that's definitely a welcome improvement, long overdue.
Okay. Finally, in AI, let's touch on the ethical conversation sparked, maybe unintentionally, by @OpenAI, bloopers by Sora 2. OpenAI showing off their video generation AI making mistakes. Is that like intentional transparency or just a clever marketing trick to show how rare the errors actually are?
It feels like a very calculated marketing move. Yeah. Aiming for that, "Aw, shucks, we're still learning humility." But the replies online, they pretty much ignored the humor and immediately pivoted to the profound risks of deepfakes. Especially with AI, this powerful at generating video.
Yeah, we saw one specific reply mentioning studies warning about how hard these things are to detect.
Exactly, and the stats are chilling. Some studies warn that up to 96% of deepfakes could potentially evade common detection methods. The social implications, the legal implications, they're enormous. You start thinking about a future where visual proof, like security footage or even video testimony, just can't automatically be trusted anymore.
Wow. That's an immediate erosion of trust in what we see.
It really is.
Okay, let's transition now to business strategy and global shifts vibe-wise. If AI is disrupting visual proof, just imagine what it's doing to legacy media. Venture capitalist Chamath Palihapitiya has a pretty harsh take on current M&A activity. All of these media deals either make complete sense or absolutely no sense because of the below. In my opinion, it seems like these deals are the equivalent of trying to catch a falling knife. It may make much more sense to wait a year or two and then start a de novo studio. So Chamath is calling recent media mergers like the speculation around Disney and Fubo TV basically a disastrous strategy right now. Why so pessimistic?
Well, his core argument ties right back to the AI speed we were just talking about. He believes AI can already generate scripts, cast actors, optimize content production faster and cheaper than existing human-run systems. And when technology can devalue your core assets that quickly, buying up legacy companies with all their existing structures, strategically unsound in his view.
So instead of acquiring, as he puts it, baggage-laden assets, old studios, big contracts, union issues, he's saying just wait until the tech matures more.
He favors waiting a year or two, then launching de novo studios. Studios built from scratch, totally optimized for AI native production from day one. Catching a falling knife is a powerful metaphor for holding on to assets he clearly sees as being rapidly devalued by automation.
Okay, shifting gears to another future-proofing strategy. This next post highlights a phenomenal shift from a major global player. This one comes from @UnusualWhales. Saudi Arabia is building some of the world's biggest solar farms, along with giant arrays of batteries to store their electricity till after dark. The rapid rollout is making the country into one of the fastest-growing markets for solar power from a near-standing start per WSJ.
Wow.
Saudi Arabia, the oil powerhouse, becoming one of the fastest-growing markets for solar. That's a monumental shift in global energy strategy, isn't it?
It's the physical manifestation of their Vision 2030 diversification plan. They're aiming for 50% clean electricity by 2030. That means 100 gigawatts of capacity. And the critical strategic detail here, those integrated giant battery storage arrays.
Right, the storage. That tackles the fundamental problem with solar intermittency. Can't rely on it when the sun isn't shining.
Exactly. It lets them store power generated during the day and use it after dark, making the supply reliable and economically. This frees up potentially $20 billion worth of their oil annually for more profitable export. Plus, it provides the cheap, reliable energy they need for new industries, like the massive AI data centers they're planning to build. Their solar costs are now reportedly 2/3 cheaper than current rates in Europe.
That puts us in a really interesting competitive spot globally. Okay, let's wrap this deep dive with our wellness and culture vibes, starting with the rapidly escalating price of sleep fitness. And Pedesi has a pretty potent critique on luxury tech. Feel like they are really testing the limits on what people are willing to spend. $1,000 per pillow, $1,000 for a blanket PLUS, the monthly fee, plus the pod. I already spent $5,000 and 200-year margins. Got to be good, seriously. $1,000 for a pillow. This feels like it's really testing the absolute upper limit of what even affluent consumers will pay for, marginal improvements in health tech.
Yeah, the product is 8 Sleep's new pod pillow cover. It uses water circulation cooling, but it's priced as this expensive add-on to their already existing $5,000 mattress system and the $200 annual subscription. The whole ecosystem is just extremely exclusionary by price.
I know there's science behind cooling your core body temp for sleep, but what about specifically cooling the head? Is that effective?
Well, clinical studies actually do back it up. Cooling the head by just 1 or 2 degrees Celsius can reduce the time it takes to fall asleep by maybe 20–30%. But the poster's critique really hits the nail on the head. When the basic system already costs $5,200, how much real value is left in these incremental, super high-cost add-ons?
Right. It suggests maybe focusing on discipline and fundamentals might be more impactful than just constantly acquiring the next expensive gadget.
Which leads us perfectly to the ultimate longevity guru, Bryan Johnson. Spends, $300,000 a year on his body? Yet gives surprisingly cheap advice. This is from @Bryan Johnson.
Hey, rich people. You shouldn't be spending more than $50,000 on top-tier healthcare. Even an all-out at-home clinic like mine is $300K. The most powerful health and longevity therapies available to you are no alcohol, finishing eating 4 hours before bed, screens off 60 minutes. Okay, get this. The guy with the $300K at-home clinic budget says you're wasting money on exotic therapies if you haven't nailed the basics first. That's phenomenal self-awareness and pretty solid advice, actually.
It's such a powerful contrast, isn't it? He argues that foundational habits, things like optimizing sleep hygiene, having strict eating cutoffs before bed, completely eliminating alcohol, those yield greater, more reliable longevity gains than, say, expensive stem cells or fancy gadgets.
And his advice, despite his own extreme budget, it's actually backed by pretty solid science.
It is. That no alcohol recommendation, for instance, lines up perfectly with a big 2022 Nature analysis that found basically zero longevity benefit from even modest alcohol intake. He's essentially saying discipline is a better long-term investment than just buying more tech.
Okay, finally, let's quickly touch on a culture vibe, the purpose of classic literature. That Roman helmet guy sparked a huge debate about how we teach Shakespeare. Why did we make reading Shakespeare such a big part of being educated? No one was supposed to read Shakespeare. You're supposed to watch it. They're plays. It's like if 400 years from now we made reading the Star Wars screenplays the mark of an intelligent individual. Is reading Hamlet really just like reading a Star Wars script? That frames the debate really well.
That's the core tension, right? Well, yeah, they were absolutely meant for performance. The replies online really emphasize the poetic depth, the textual inventions, things you only get from studying the text itself. If you only see it as a script, you miss stuff like how Shakespeare literally developed the English language, coining phrases like green-eyed monster or
Right.
break the ice.
So the argument is the text itself is an independent work of linguistic art, separate from just the action on stage.
Yes, exactly. And historical context matters too. Renaissance teaching actually often paired reading the text with acting and recitation as a way to build rhetorical skills. The text was always meant to be studied, memorized, and performed, not just passively watched.
What a feed today. Seriously, we covered everything from Tesla's clever leasing strategy and Metaplanet's big Bitcoin hedge against the yen,
Mm.
all the way to the, frankly, ethical gravity of Sora deepfakes and the astronomical cost of comfort in some wellness tech.
Yeah, and if you pull the thread between that expensive sleep fitness tech we talked about and Bryan Johnson's, well, surprisingly basic longevity hacks, you see this consistent theme emerging, don't you? Across almost all these segments, really. Where are we being convinced maybe to buy expensive tech solutions when simple discipline or just fundamental reevaluation is the real key? We saw it in Chamath's critique of media M&A. We definitely see it in the cost of that $1,000 pillow. So if the cheapest, most foundational habits are scientifically proven to be the most effective for health, where else might you be choosing a subscription or a pricey gadget over just simple behavior change? That's the question to mull over today.
Thanks for diving deep with us. We'll catch the next wave of trending sources tomorrow.